Bismillah ar-Rahman ar-Rahim. Assalamu alaikum. Welcome all to today's MSS session, full year 2024 review, Liva Group SAOG. The date today is the 26th of March, 2025. I'd like to begin today's session by reading the disclaimer you can all see on the screen today. The material in this presentation has been prepared by Liva Group SAOG, Liva, and is general background information about Liva's activities current as of the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation, including forecast, financial information only, if any, should not be considered as advice or a recommendation to investors or potential investors in relation to holding, purchasing, or selling securities or other financial products or instruments, and does not take into account your particular investment objectives, financial situations, or needs. Before acting on any information, you should consider the appropriateness of the information having regard to these matters, any relevant offer documents, and in particular, you should seek independent financial advice. This presentation may contain forward-looking statements, including statements regarding our intent, belief, or current expectations with respect to Liva's businesses and operations, market conditions, results of operation, financial condition, capital adequacy, specific provisions, and risk management practices. Readers are cautioned not to place undue reliance on these forward-looking statements. Liva does not undertake any obligation to publicly release the result of any revisions to these forward-looking statements to reflect events or circumstances after the date hereof, to reflect the occurrence of unanticipated events. While due care has been used in the preparation of forecast information, actual results may vary in a materially positive or negative manner. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Liva's control. Past performance is not a reliable indication of future performance. I'd like to run through the agenda for today's session. We will commence with introducing Liva's representatives on today's session, and then we will follow that by doing a year-in review and our financial highlights, and finally presenting our strategic outlook. We will then have a Q&A session for our audience to ask questions to the Liva representatives on the call, and you can do so by either raising your hand on MS Teams or by typing out your question in the chat on the app. On the screen are the Liva Group representatives who will be presenting today and on the line. I'd like to introduce you to Mr. Martin Rueles, our Group CEO, the Honorable Dr. Dhafar Al-Shanfari, our Group COO, Mr. Ravikant Petluri, our Group CFO. I'd like to introduce myself, Sarah Faraj, the Group Legal Director, who is the moderator on this call. And I'd also like to introduce the presenters who are on the line, Hana Al-Hinai, the CEO of Liva Insurance Oman, Mr. Mohammed Al-Tublani, the Acting CEO of Liva Insurance KSA, Mr. Adal Sarwar, the Group Chief Personal Lines Officer, Mr. Guido Zagati, the Group Chief Commercial Lines and Reinsurance Officer, and Ms. Eugenie Molinu, the Group Chief Risk Officer. Thank you all again for joining today's session. I'd like to hand over to our Group CEO, Mr. Martin Rueles, who will begin with our year-in review.
Thank you. Thank you very much, Sarah. And good morning, everybody. Thank you so much for taking the time to be with us today, because I think particularly 2024 is a year that needs explanation, but it's also good to understand what's going on beyond the numbers. And please allow me to start as we take stock of the full year 2024, but also look ahead. I really want to reflect for a moment, not only on numbers, but also the story the numbers tell, and we want to embed in it. For me, it's about the business that was tested by external pressures, but also sharpened by strategic focus and quietly building something resilient, enduring, and valuable. But let's start with the obvious headliner this year, the weather. We all felt it. 2024 delivered some of the most challenging weather events we have seen since recording started. Volatile, widespread, and costly. The impacts on our profitability was real, a negative 22 million profit after tax impact on the weather alone. That could have been just a footnote, or it could have been defined our year, but we choose a third path to leverage it. We used disruption to interrogate our exposure management, to test our risk appetite in real conditions, to accelerate our capabilities, to upgrade where we already had plans, but now the perfect reason to prioritize. That's the difference between reacting and responding. And that mindset set the tone for the year 2024 for us. Because while the weather hit hard, our response proved something more important. Resilience isn't what you build in good times, it's what shows in the hard ones. And so against that backdrop, we doubled down on profitability prioritization, not as a slogan, not as a quarterly target, but as a core strategic principle. We knew we had to protect margin while continuing to invest in long-term value creation. That meant being clear on what we would pursue and what we would step away from. It meant saying no to volume for the volume's sake, and yes to price discipline, portfolio refinement, and technical and underwriting excellence. And it's working. Despite the weather impact, underlying profitability was solid. 17 million profit after tax excluding the weather, and the second half of the year we grew 47% year on year. That's a clear signal that our engine is healthy and gaining momentum. But we didn't stop there. We got to work on technical resilience, something that often doesn't grab headlines but underpins everything. We upgraded models, stress tested our reserves, tightened the feedback loops between claims, pricing, underwriting, and we made sure our reinsurance structures were aligned to the real risk we face. All of this took place quietly, but delivered tangible results. We are not just better informed, we are better prepared. And this brings me to the strategic expansion. It would have been really tempting in a year like this to retreat, to play it safe, but instead we made targeted, deliberate moves into markets, partnership and business lines where we saw long-term alignment with our capabilities and our ambitions. We are not chasing growth, we are curating it because we know the scale without strategy leads to fragility, but scale built on strength, that's how you build a business that is resilient and endures. And underlying all of this was a quiet but powerful enabler, our investment strategy. In a volatile macroeconomic environment, with interest rate shifts, market noise, global uncertainties, our dynamic and proactive approach delivered an impressive 11% year-on-year growth in investment returns. And that's not luck, it's discipline. It's knowing when to lean in, when to hold back, and where to focus. And with that, we come to the headline numbers. Revenues grew 6% year-on-year. Profit after tax, excluding the weather, landed at 17 million. Investment returns up 11%. The second half profitability up 47% year-on-year. And we achieved all of this while absorbing one of the toughest weather years we have seen in recent memory. That, to me, is not just a decent set of results, it's a signal of direction. Because it's easy to perform when the winds are at your back. But what we did this year was different. We faced headwinds, real ones, and did not just hold steady, we built strengths. So where do we go from here for 2025? It leaves us with confidence, but not complacency. We know the environment remains dynamic. We know we still need to keep evolving, sharpening our tools, strengthening our partnership, and staying true to our strategic North Star. But we also know that we have built something meaningful this year, a business that doesn't just talk about resilience, it demonstrates it. A team that doesn't just measure performance, it delivers it. And a strategy that is not about chasing headlines, but building sustainable long-term value. We have turned a challenging year into a foundation, and now we build from here. Now, I look forward to our discussions towards the end of the session, but for now, let me hand over to Ravi, who will go a bit deeper into the financial result and explain the various segments and parts. Thank you very much. Over to you, Ravi.
Thank you, Martin. Good morning, everyone. So in terms of the financial highlights, with respect to our performance for the year ended 31st December 2024, as we reported earlier, we had a challenging first half of this year, primarily the results getting impacted as a result of unprecedented weather events, particularly in UAE and elsewhere in the region as well. So that sort of impacted our results. However, as Martin mentioned earlier, the business has seen a very strong turnaround in the second half of the year, not only with respect to the insurance revenue, which increased by 173 million Omani riyals in the second half of this year, but also from an insurance service margin and result perspective, where the overall insurance service margin and profitability of our insurance operations reported a significant turnaround of 13 million Omani riyals compared to 18 million loss that was reported in the first half of this year. Again, while on a net basis, we ended with an insurance service result of 6 million loss. But as Martin mentioned earlier, the second half turnaround was quite impressive. In terms of the overall profit after tax, again, a similar reflection where there was a strong turnaround in the profitability in the second half of this year, where the business reported a profit after tax of 11 million Omani riyals compared to 6 million profit for the entire 2023. Again, offset by the loss that was reported in the first half of this year of 16 million Omani riyals. In terms of the overall investment income, again, Martin talked about the numbers. So in 2023, the business reported an investment income of 12.8 million Omani riyals. However, with a disciplined investment strategy, focusing on investments and optimizing the portfolio to generate risk-adjusted, well-balanced returns, the year 2024 ended with an overall investment income of 14.3 million Omani riyals, reflecting a very healthy and substantial increase of 11% on the back of a substantial increase that was reported in the year before as well. Again, we talked about the strategy earlier with the community, where we said that our strategy continues to diversify our product portfolio as well as the geographical portfolio that we have, so as to achieve a balanced portfolio which will provide sustainable returns to the group on a medium to longer term basis. And on this slide, you can see the diversification of the products that we used to have back in 2022, which was heavily reliant on the medical portfolio, particularly in Oman and UAE, which has now reduced to 50%, despite the actual growth in the life and medical portfolio. So while the life and medical portfolio in reality has grown substantially from where we were back in 2022, however, its contribution to the overall portfolio has reduced from 64% in 2022 to 50% as of 2024. Again, this diversified growth, because overall there is a growth of insurance revenue from 217 million back in 2022 to 329 million in the current period. That growth has come because of an enhanced and increased contribution by motor, which increased from 23% as a part of the overall composition to 25% in the current year, and a significant growth that we have achieved, again, to achieve the strategically balanced portfolio. We have increased our exposure to the non-motor portfolio, which used to be 11% back in 2022 to 23% as of 2024. Again, the strategy continues to reduce our reliance on the motor, on the medical portfolio, particularly in UAE and Oman, while increasing the more profitable segments of the portfolio of motor and non-motor. Again, following the same discussion, and as I said, following the strategy of diversifying, not just from a product perspective, but also geographical diversification, because that, in our view, helps the sustainable returns that the portfolio can generate. Again, I've given a comparison of where the portfolio stood from a geographical perspective back in 2022 to where we are at the end of 2024. Effectively, again, back in 2022, UAE used to be one of the major sort of contributor, primarily as a result of the legacy businesses of National Life and RSA Middle East, which had a significant presence back then. However, with the significant increase that we have witnessed in the UAE portfolio of both life and medical, as well as motor and non-motor, particularly non-motor in UAE, the UAE continues to represent 60% of our portfolio as of 2024, compared to 51% back in 2022. However, you can also see a significant increase in the KSA, which is, from our perspective, a very, very attractive market. And we are increasing our exposure in the KSA market, which now represents 14% of the overall portfolio compared to 9% back in 2022. Similarly, Oman, again, while the group book is gradually moving ahead and increasing, but its overall contribution, primarily on the back of a significant growth that we have witnessed in UAE, the exposure of Oman portfolio has now reduced to 24% compared to 36%, which was the case back in 2022. In this slide, we just want to quickly give you a snapshot of the performance of each of our core markets. Again, I'll start with UAE, which continues to be the largest segment. As you've seen before, the overall contribution to the insurance revenue of UAE business now stands at 199 million Omani riyals, with a very strong profitable book, despite the results getting impacted, as a result of the weather event that we talked about earlier. However, again, there was a strong turnaround that the UAE business saw in the second half, where the second half of the business contributed to close to 8 million Omani riyals profitability to the overall group. UAE, again, followed by Oman, which has contributed 78 million Omani riyals in terms of the insurance revenue to the overall group revenues. And Oman, again, was a very strong turnaround story. If you would recall, Oman business had some challenges in the previous year, primarily as a result of the post-COVID implications on the life and medical, etc. Again, all those challenges were addressed in the current year, and Oman in particular has turned around and has become profitable compared to the previous periods, not just on the overall PAT perspective, but also on the back of a very strong turnaround on the underwriting results. Oman, again, followed by KSA. KSA was a big turnaround story for us this year as well, while the overall contribution of KSA business to the group revenue stands at 46 million Omani riyals. But the story was more on the profitability turnaround. For the first time in our history of operating in KSA, this business has been profitable at the underwriting level. While it was profitable in the previous year as well from a PAT perspective, this year was specifically a turnaround with the focus and the operational excellence that we brought in the KSA business. We managed to report a profitable underwriting results, again, aided by a significant investment income increase, resulting in a very strong profitability of KSA business, significantly higher compared to the profit that was reported by KSA in the previous year. Bahrain, again, remains a very strong market for us, relatively smaller in terms of its contribution to the overall group revenues, where it contributed to Omani riyals 1 million to the overall group revenue. However, we are positioning this Bahrain business to explore significant market opportunities that are coming up, and currently we are exploring and positioning ourselves to leverage the opportunities that Bahrain market is bringing to the group. Kuwait, again, continues to be a steady business for us. Overall contribution of Kuwait business stands at 5 million Omani riyals. And this year, particularly for Kuwait, was a year where we wanted to focus on, again, strengthening the underlying processes, underwriting principles, etc., while enhancing the digital transformation and to enable and position the business in Kuwait to explore significant opportunities that are currently available in Kuwait market, particularly in the commercial lines and non-motor segment. So again, that's what I wanted to share in terms of the overall numbers. However, again, as Martin mentioned earlier, this year, particularly for us, was a testing period, especially on the back of the first half performance. And we undertook several enhancement, fundamental changes to our processes and underwriting principles, revisiting the business models to align them to the current emerging market dynamics, and to empower the long-term strategy of diversifying the businesses, both in terms of products as well as geography, while keeping a very close watch on the profitability that this business is expected to deliver. Again, we emerged from unprecedented series of events. However, the robust improvements to the business that was carried out, again, throughout the period since the integration and acquisition of both businesses, which saw a significant impact in 2024, and particularly in the second half, where we didn't have any major, offshoots of the weather event impacting our results. As a result of which, again, H2 PAT that we reported of 10.2 million was delivered, compared to, again, 8 million Omani Riyals PAT in the first half, excluding the weather impact that we talked about earlier. Our focus in this year continues to be, again, enhanced technical capabilities. We are enhancing our practices to make this business much more resilient to challenging market conditions, while improving the processes, pricing, and the agility of the business to respond to the current market opportunities, with dynamic pricing adjustments. Again, UAE second half particularly was a case in point where we responded to the market conditions. We enhanced our pricing for the products to offset the impact of the weather. The overall price adjustments, particularly in the UAE market, was close to 25% in the second half of the year, in addition to the volume growth. Again, I just wanted to make a point here that, this was a testing time for Liva as a new brand in the market as well. Given the weather event and the magnitude of the challenge that Liva has to face, we focused on customer experience. We were very fair with claims adjudications. We paid everything that we were supposed to pay based on the fair practices and the contractual obligations we had. And that actually was evident in the volume growth that we saw, particularly in UAE again in the second half, in addition to the price adjustments, which again helped us report the second half strong profitability turnaround. Now, again, reinsurance, one of the pillars and the backbone of our business. Again, we revisited the overall reinsurance strategy in order to make sure that it is aligned with the nature of the business that we carry out and the plans that we have to grow the business, while geographic expansion and diversification of the reinsurance portfolio did help us. We also enhanced stability and long-term volatility management coming as a result of the CAT events and any major large losses and claims that we might witness given the growth that we are looking at. And we took this opportunity to further enhance our reinsurance program, bring in additional protections to minimize the volatility that the business brings, on the back of a strong growth that we've talked about earlier. So with that, I will like to hand it over to our Group Chief Operating Officer, Dr. Dafer Al-Shanfari, to take you through our strategic outlook and the plan for the year 2025 and beyond. Thank you.
Thank you, Ravi, and greetings all, and thank you for being here. Wishing everyone a blessed Eid holiday and see you annually in good health. We have been since day one, since the merger, since we've become Liva, have been steadily and will continue to move forward towards our vision of becoming one of the leading insurance groups in the region. It's not going to be an easy path full of market challenges. There will be always plenty of opportunities. We have the support of our shareholders, our stakeholders, and the strong drive of our management to achieve this. And so looking ahead, strategically, we've been diversifying our segments. As you've heard from colleagues Martin and Ravi, we've been diversifying our business lines across different geographies, scaling up Our life business, especially in the UAE and Saudi Arabia, has been one of the fastest growing and most under-penetrated segments in the region. And we aim to capitalize on the growth of these two largest and increasingly sophisticated markets. We aim to build our competitive advantage as a multi-line, multi-territory insurer, servicing the evolving needs of the more financially aware customer through added product offerings for them and their families. While our PNC business continues focusing on growth and diversification as part of our strategy, macro factors, the population growth, the dynamics around the economic visions, the government drive to increase more local contents in all markets and mainly seen clearly and more visibly in the Saudi market are driving continuous demand for traditional insurance products and non-traditional products. And KSA focus is obviously, as emphasized, is the largest opportunity when it comes to scaling up. We meet evolving customer needs with government support, which is always there. The UAE and Oman, we will continuously, as always, work on diversifying, finding efficiencies, and growing the existing partnerships through innovative products, new channels, and cyber SMEs and others. On health, evolving customer needs require us to expand our thinking beyond traditional health products, ongoing development of health ecosystems in the UAE to unlock synergy, efficiency, and new opportunities. We have been recently awarded the participating insurer status in the UAE. This will definitely allow us to service new segments and diversify for profitability. Scaling health presence in KSA to meet evolving market needs is a priority, and thus we have been working on our inorganic growth strategy with the Malad discussions and other discussions around the region that will definitely disclose in due course. Of course, we continue our strategic key partnerships. We have, which is always playing a key role in helping us better serve our customers and understand our markets. Partnerships to build a mutual respect and shared success help us expand our reach and enhance our customer access. We have been collaborating with SALIC, with Realm recently, with others on the way, and it reflects our commitment to creating value through strong, mutually beneficial relationships. These strategic initiatives are built on strong foundation of core enablers, which include digital enablement, which is a very key enabler we are investing in, advancing automation and efficiency to customer experience and streamlining operations. We have been working on claim efficiency management, fraud and waste and abuse through various technologies, Sherlock and the likes, exploring digital health also propositions and applications with AI capabilities, powered patient journey in Oman and the UAE. A key enabler is also customer centricity, which is always focus, strengthening our customer first culture through better data design and retention strategies. Mentioned SALIC partnership with bringing customer first digital distribution channel in the UAE market. Tesla partnership empowering socially conscious consumers. Realm partnership, protection of new innovative assets, enhancing data management and analysis capabilities. A third key core enabler is technical excellence and driving profitability by enhancing underwriting, pricing, claims with the right tools and experience. Process enhancement continuously in the health and life pre-submissions, in KSA with commercial line renewals and the likes. Of course, people and culture is the essence of any company, and it is the focus of where we have always looked at fostering talents, building accountability, building high performance across the board, and a diverse and healthy balance between localization initiatives while retaining and encouraging international talents. We are always looking at the target operating model as a group as we expand and grow as businesses, our businesses, to enhance capability and ensure efficiency between the entities and good healthy synergy. The fifth key enabler, social responsibility. We've always been committed to our local communities. We've always been a key player in terms of understanding how we can play a role within a certain framework, within our understanding and knowledge of our business to the community. And we have been embedding ESG to go beyond the CSR, traditional CSR, to embed ESG capabilities and commitment across the company, with focus obviously on governance, inclusion, community impact. And we will be very proud of our first sustainability report, which will be issued very soon. With this, I hope I was able to give you a very high level but comprehensive view of how we are moving forward, and we look forward to engaging in a discussion today. Thank you, guys. I think it's a
Thank
Q&A
you.
session.
Thank you very much to our presenters. I'd like to now open the floor to our audience. If anyone has any questions, could you please raise your hand through the MS Teams app? Thank you. Or you can type your questions in the chat. I believe we have our first question from Mr. Abbas Muslimi.
Good morning, everyone. Thank you for the presentation. My name is Abbas Muslimi. I work as a portfolio manager for Vision Capital in Oman. The first question is right off the bat. Can you give us a little more color on the merger discussions? What's the objective behind it? And from what I understand is Malat is going to be, if at all the discussions are successful, Malat is going to be acquiring you rather than the other way around. So I just wanted to understand what is the thinking behind that, and when do we hear one way or the other? Or what's the deadline for it? That's my first question, sir.
Sure. Thank you very much, Abbas, and let me take the answer. Give you the answer to the question. As you said, obviously, mergers and acquisitions have always the challenge of confidentiality and in the process. We are both two listed companies in Saudi Arabia. So where we are now, we concluded the due diligence. We just finalized all with the full year 2024 results available. The strategic rationale for us was always, when you saw the slide where Ravi presented the market size and also the penetration we have in the market. Sorry, we have around, I think, 0.7% market share in Saudi Arabia. Saudi Arabia being the fastest growing market in the region and already being the largest market. And on the back, when you look into the market composition, it's mainly driven by medical, followed by motor and other business lines. And for Liva, while we have all the licenses, we didn't really operate the medical side. And that's when we looked at the partnership which we want to build, to find somebody who has a strong capability on the medical side, but also brings us the scale which lifts us hopefully up into the top 10 within the market, which is then the foundation we can push forward. So that was the thought and is the strategic intention where we came together with Malaf, because Malaf is exactly bringing this ahead. For the deal structuring, again, who is acquiring who? Ultimately, for us, it's a secondary factor, because again, there are some Saudi regulations, there are also shareholder considerations and others. But in our mind, again, it doesn't matter through the process how we go the best. The key is for us really, we want to support the deal to the best, because at the end of the day, we will be the major shareholder in Liva KSA Malaf if the merger goes through, no matter who acquires who. And again, in discussion with all the regulatory bodies and also the counterparty, we deemed that the approach where Malaf is the company taking over Liva, but then Liva becoming the major shareholder of the merged entity seems to be the right approach for us. Now, we hope to really move quickly, because again, there's not really time is not in our favor, in the sense the business is ready. The teams, I think, are very eager to move ahead and the opportunities are there. So again, obviously during Ramadan and Eid, we had a bit of a slowdown, but we are, I hope, in the final stretch, closing due diligence, making the last rounds of negotiations, and then hopefully coming out in the next few weeks with an update to the market, which I hope will be a positive one, helping us as Liva to really be more present in the Saudi market which I mentioned, is one of the key markets, of course, in the region.
And Martin, if I may just pass to, obviously, if we want to be one of the top leading insurance groups in the region, a Saudi market is a strategic market. Obviously, it's the scale, it's the where you do grow heavily. And currently, this fits well with also us expanding our product lines where we don't operate medical currently through Liva KSA. So with Malad, that brings us both. We increase our market share 2%. Malad, more than 50% or around 50% of their top line is from health. And so it does, as Martin say, fill in that synergy. And there's lots of potential there, but we are still reviewing the final due diligence stage and discussions with the regulators. Hopefully will be much clearer after 8.
Thank you, Dr. Shanfari. Thank you, Martin. Just a follow-up question regarding that is, I mean, given that Liva is an Omani listed entity at some point, I mean, I'm hoping that, you know, you mentioned the rationale behind it. You mentioned that Liva would be a larger shareholder, and I see that just based on simple market cap calculations and not even looking at ROE generation, you know, so we'll come to the swap ratios when we come to them. But I'm hoping there's a mechanism for Omani investors to still be part of it, you know, via dual listing. You know, that's just something I wanted to put on the record as well, right? So that's just to bring that conclusion, you know, just to close that discussion. My follow-up is, let's say for whatever reason this merger doesn't work out, and you know, both Dr. Shanfari and you, Martin, and even Ravi has mentioned the potential of the Saudi market. What's the strategy then? You know, how are you guys looking to expand? You know, how are you guys looking to sort of grow your business in Saudi in the event that the merger doesn't go through?
Yeah, that's a good question, and of course, something we looked at even before we started the discussion on the merger. And we see multiple angles, and maybe I can hand over to Mohammed, who is our CEO of the Saudi business. But from a group perspective, there's always the market in itself goes through a consolidation. And Mohammed can explain a bit on the organic side, because that's the other element, because during the transition, even going through the merger discussions now, the business started to grow significantly, and Ravi mentioned profitability. But for us, again, consolidation is something we clearly see in the Saudi market. And in all honesty, I don't think it's purely Saudi. We see other markets, insurance markets across the GCC, still be very much driven by consolidation, even UAE, but also smaller markets, Bahrain and so on, which is something which for us is always interesting to see whether there's a strategic fit. So to answer your question, from an inorganic perspective, there are other ways to accelerate, I would say, our presence in Saudi Arabia. But we also look very much into the organic way. And that's maybe, Mohammed, if you want to share a few key initiatives and key elements we have been working on. Because even if that's not happening, and if we decide to go organic, we are quite confident that we are strengthening through our shareholder base, through partnerships, and through innovation and product differentiation, our standing in the KSA market. Not sure, Mohammed, you want to add a few words?
Sure, Martin. Thank you, Martin. I think over the past couple of years, we've invested heavily in the digital transformation. And as you may know, one of the main strategic moves for KSA or Liva KSA specifically is capturing one market share, maintaining our profitability with the achievement of the turnaround that was done over the past couple of years. But then one of the maybe examples that I can share with you is the digital transformation on motor specifically, where historically RSA time, we did not penetrate that market. However, over the past few years, we've penetrated it. We've been one of the main contributors into the market or market acquirers in terms of motor. And in that specific line of business, which is a very competitive line of business, we've achieved profitability, we've achieved growth as well. Other than the motor, we look at the opportunity from property and casualty perspective as well. So property and casualty have contributed around 30% or 25 to 30% of our portfolio, and that continues to grow. Maybe another opportunity to name is the fact inward. We're one of 5 insurance companies in KSA holding reinsurance license. So all of these opportunities will enable organic growth as we saw over the past few years. So again, these are some of the examples If you have any more questions, happy to take them as well.
Thank you, Mohammed. Sarah, if you'll allow me, I don't see any other hands raised. If I can continue with my questions.
Please go ahead, and after that, we'll address the question that's been put on the chat. Thank you.
Okay, yeah, thank you. Martin, now if you come to your big sort of, geographical footprint, which is in the UAE, followed by Oman, and, Oman, unfortunately, has been on the receiving ends of, these NatCat events over the last decade or so. So, and now, unfortunately, UAE faced that last year, you sort of spoke about it, and, you bounced back pretty sharply. What sort of conversations have happened with the reinsurers? Has your reinsurance strategy changed? Has your, rates of reinsurance changed after this event? I'm just trying to get some color on, what's going on in the aftermath of this event.
I think it's a very good question, and thanks for raising it, because it clearly, I think it was a wake-up call for many of the markets. As we know, the composition, particularly in the UAE, and I'll let Guido explain a bit more on the direct reinsurance side and the market reactions, but the clarity is there, and you see this again not only in the UAE. I was just seeing news coming out of Saudi Arabia. Insurance companies are not retaining much of the risk. They're heavily reliant on reinsurance companies, and most regulators in the region would love to see more retention, staying in the region, building the capabilities, underwriting capabilities in-house, and claims capabilities then as well. And for us, I would say the advantage is that was always the DNA of Liva. We are an underwriter, we retain risk. Now, obviously, in a bad year, you will see we have the other side of the coin, where the results of underwriting or of NatCat are coming through. But then the market, as it's heavily driven by reinsurance, you can clearly see that obviously then the reinsurers are taking a lot of the impact of the claims in the UAE. And you would see similar things, I think, happen in Oman before with the big claims a few years back. So, and that's where your question, I think, is very accurate. It's a question of how much the reinsurer and how do the reinsurer react. Now, my take is, and again, Guido, who is looking after our reinsurance for the group, will explore a bit more. But globally, it's not an event that really made a dent. It's around a $3 billion event, which happened last year. But having said so, for the market, and then I think for the reflection of the reinsurers, where do they deploy their capital, with whom they partner and how they partner, that sharpened things quite significantly. And that's where you started seeing also rate increases for end customers coming through, heavily driven by reinsurance adjustments, higher limits, higher deductibles, new rates. But Guido, maybe you can add a bit more color and flavor and detail and answer the question of us.
Certainly, Martin. Good morning, everyone. Good morning, Abbas. And so just to support, obviously, what Martin said, the reinsurance strategy of Liva is a long-term strategy and position Liva as effectively a risk carrier in the region. It has been designed over a blend of experience. So what were the result of Liva so far and pre-Liva, specifically RSA, and based on the current book, the current exposure, what is the expectation going forward? So the full modeling being blend of exposure and experience actually has been designed to deliver a long-term growth, profitable growth in the years to come, which of course has exposed us to a year and was for us the first year to a higher level of volatility. Higher level of volatility, which obviously is not gone undetected and obviously has been taken seriously, has been actually a new strategy, has been a revamped strategy has been put in place to make sure that the volatility through the purchase of a strategic restatement premium protection is kept going forward. And of course, we are approaching the treaty renewals, which for us is the 1st of July, and we'll be looking specifically at structure, which will be an optimization of the current one, looking at leveling any potential volatility coming in future. Your question was, what about the reinsurers? So reinsurers actually value a lot what Liva is doing, value the technical approach that Liva has been embedded in the discipline, in the daily discipline, values the fact that there was absolutely no loss creep following the events. So we approached the last renewal in July, so 2.5 months after the event. And obviously there was in the market a lot of emotion of what would have been the ultimate net loss for this event. In every company, and specifically us, we came up with what we believe was the best estimate. 1 year later, the best estimate is still remain the same figure, meaning from an insurance perspective, the insurers are very happy to see that we were able to establish clearly what would have been our ultimate landing point, still with a bit of prudency. As on date, especially on non-motor, we still have about 70-75% of claim reserves open, which are at the same time being corrected and obviously reducing. So we obviously remain ambitious of the fact that our projection probably in the long run will be better than we told the insurer. This hasn't gone undetected, and in fact, the last year renewal, there was a lot of trust for what Liva was doing, and the overall price of insurance for us hasn't really increased, has remained stable according to our planning. But the good thing is that in the meantime, Liva has been able, and this is probably also answering one of the questions that we have on the chat. Liva has been building, relooking at the underwriting practice. So what does that mean? It means that the opportunity which Martin described at the very beginning, how obviously to capitalize on what happened, meant that we have completely re-underwritten, especially the legacy portfolio coming from the RSA days. We have been embedded a stronger risk engineering approach in the risk selection, meaning being able to detect risks which are exposed to natural events, embedding, for example, digital mapping of the territory, and therefore being able in advance to understand whether a risk which is in our portfolio or we are potentially considering is a good risk or is an exposed risk. We've been increasing and putting adequate deductible for all risk suffering out of the natural events. And this has improved dramatically, our portfolio. And the result of all of this is that on a as-if basis, with all the measures put in place, our gross incurred, same event happened today on the current portfolio, would have been actually 30-35% less impactful in terms of non-motor reserves. This is the power of the action that we put in place. This once again hasn't gone undetected by the insurers, which actually are coming to our office, quite often in preparation of the next renewal. And we have, I think, a good story to tell, which now position also in a good scenario, which for the first time in 7 years sees the worldwide reinsurance market in a discounting phase, in a softening phase. So we're very bullish that the next renewal in July will be able to extract better value from the insurer and having the adequate support from the top international securities, which are very interested in the Liva story, especially for the traction that they've seen in the last year. Last thing I wanted to add, we've obviously also capitalized, and sorry for being long, capitalized on the price increase. We've been able actually to increase our rates, both in motor and non-motor, substantially. And that's, again, it's a value that from an underwriting point of view, we bring to our shareholder. Thank you.
Thank you, Guido. I really appreciate that answer. Very well-rounded and great perspective. Sarah, I'm happy to wait my turn. I think you can go ahead with the questions in the chat. I have a few more questions. I'll come back to the management.
Thank you very much, Abbas. I'd like to just address the question that Mr. Alok Nawani posted. I'll read it out loud and then I'll point to the presenters to respond. The first question is, what were the source markets for the underwriting improvements seen in H2 2024? Does management view the combined ratio improvements seen in H2 2024 to be sustainable moving forward? Are the weather impacts fully provided for in 2024? Or can we expect residual impacts moving forward? The second question is, can management quantify the solvency position of the company as of 2024? And what should we expect from the company in terms of dividend policy moving forward? Then finally, the third question that was posted, can management provide us with an update on the prospect merger with Melaf? What would be the modality of the merger? Should we look for an all-share swap or would there be cash involved? What is the current ownership of the group in Liva KSA? And how would that ownership evolve post-merger? Would Liva still be able to consolidate the merged KSA operations? And finally, what is the expected timeline for merger completion? Thank you, Mr. Alog.
Well, maybe, Sarah, if you allow me, we do it in the reverse order to just link it back to the merger. So if I can start with maybe number 3, and then maybe we'll go to number 1, because Guido, I think, is very much aligned with what you said, but I think Adal, you might also be able to add a bit. And then Ravi and maybe Eugenie, you can have a take on the second one. If that's okay, then Sarah, I take the third one, which again is very much aligned with what we said. But just to recap a bit, the modality of the merger is a share deal. So again, the structure and the common structure in Saudi Arabia, also where there's a framework given by the regulators, is really adjusted book value transactions very much as mergers, and trying to keep it simple, because we are exploring other options, as you mentioned, which involving cash or which strengthening also the ownership position of Liva through the merger, which in itself we decided, no, step 1 clearly for Saudi Arabia is a share swap, basically, which will happen, which leads a bit to the other questions as well. Obviously, you're rightfully asking, what's the shareholding of Liva today? Liva today in Liva KSA owns 51%, roughly rounded, followed by Riyadh Bank, who is also shareholder on the group level, but has a direct shareholding, and then other shareholders in the operation. So now the question is, as you ask, what's the shareholding after the transaction is done? Now, that's difficult to answer. Again, you see market value, you obviously can see the book value, but through the due diligence, of course, there will be adjustments to the book value, and it will be on adjusted book value. To be anticipated that we will drop through the merger from the 51%. Having said, and I think that leads to your other question of saying, is consolidation then still there? And maybe I'm speaking under control of Ravi from a accounting, finance, and audit perspective. So yes, ideally you have 51%. It's very straightforward, but there are also other measurements and means which are quite important, which can define consolidation. And for us, by nature, I would say we always strive for consolidation, ideally in phase 1 of the deal, which is the merger, and potentially then as we see the business evolving. And again, these are obviously board memberships, these are technical service agreements, these are the ways we work as a group with the Liva KSA entity, which can help us to make the case that we still consolidate, even if we drop below the 50%. So it is the aim, I would say, through the merger to keep consolidation of Saudi Arabia into Liva Group. And finally, on the timelines, as I mentioned, we are at the end of the due diligence now in the final round of negotiations, also engaging with all the regulators to make sure we are aligned with the processes. I would hope that it's a question of weeks now to close this one off, and then we come back to the market and get all the approvals and the EGMs hopefully done in the coming quarter to ensure that the deal moves on and we are really focusing on the business and the growth and the integration of the two businesses if and when the deal is approved. I'm not sure, obviously, Dr. Dafer, Ravi, anything to add from your side? I know we have many other questions, but...
No, I think we've covered it all, Ravi, I'm not sure.
Yeah, no, absolutely, Martin. I think you've covered it all. Again, just on the consolidation piece, I think just to reiterate, our aim, remains to consolidate the operations in KSA, which is currently the case, and we would expect the similar situation going forward as well. However, we will have to evaluate it once the final terms are agreed between the parties, whether from an accounting perspective we can still demonstrate control and continue to consolidate the KSA on a combined basis.
Perfect. Well, thank you, Ravi. Maybe I just jump into question 1 to give the opening, and then maybe Adel, you can get your view, because Guido shared a bit already on weather and the impact on the market. Again, there are 2 ways to look at it, and I think, as you mentioned, I think the second half is obviously a strong indicator of where we are heading. But you could also look differently. You could also remove the weather from the first half, and you would already see a strong underlying performance. That means the underlying business, and I mentioned this before, is very strong. And yes, we clearly anticipate and expect, and we are quite confident that this will continue beyond 2024, this should continue into 2025 on the back of the strength which was built in 24. But again, to be very fair, it started 23 and 22 even. So that's a journey of continuation, which I'm quite confident it will be there. When you look at the reserving, yes, we have been fully reserved. We have been using international standards. And again, maybe Eugenie, as our Chief Risk Officer, want to add a small sentence at the end. But clearly, it is our approach and is our way of looking at things that we always reserve things to the full extent when they happen to the best of our knowledge. And I would say the good news, and again, we could go much deeper there, but when you look at the reserves we kept at end of Q2, which is really fresh out of the weather, they had not to be increased. As a matter of fact, we started to see decreases in the reserves, which again, for me, speaks very much on the process, capabilities, and competency, because we know what we are doing. And seeing now positive runoff, that's what I always would hope on the back of a Nat Cat event. Now, it goes back to the question, maybe Adel, you're in a good position to answer on the momentum in the second half. Ravi explained in his speech that, of course, and Guido mentioned as well, we have rate increases, let's say, for example, in motor, but also through the management of the claims, we see significant increase in volumes. That means we have new customers joining us. And maybe, Adel, you can highlight how and why this gives us the confidence that this is a sustainable momentum we built, which goes into 25 and beyond.
Thank you, Martin. Yeah, I'll just add to that. And I think Martin's largely covered the momentum we built into the business. And I think we're all feeling very confident about the sustainability of that business. So our underlying key metric that we measure to define our loss ratios is attritional loss ratio. That's the claims we pay on our portfolios, and that should be easy to project. And what we're seeing, we have a stabilized trend on our loss ratio. Of course, post the rains, it was an abnormal event. We've seen price increases in the market, and that's helping with the immediate future. Over time, we expect them to level off. But there's other aspects other than the rains that we're managing and looking at closely. Inflation in the market, that impacts claims cost as well. And this is something we've got really good grip of, and we expect our loss ratios to be stable in the immediate future.
Perfect. Thank you, Adel.
Thank you.
Just breaching into the middle question, maybe Ravi, which is linked to solvency and a few other elements on finance.
Well, let me take the dividend policy piece first. In terms of our policy for declaration of dividends and distribution of dividends to the shareholders, it pretty much remains the same, but it's always aligned to the current performance of the business. Again, as a result of a challenging, 2024, the board has not recommended any dividend and directors' remuneration, if I may add. However, our policy still remains the same. The moment we believe that the business has come to a position where it is delivering sustainable profit, we will continue to declare dividends. That being said, again, 2023 we did declare mandatory convertible bonds as dividends to the shareholders, and our endeavor would be to pay the return that we have 6% coupon that we are required to pay this year as well. So that's on the dividend piece. In terms of the solvency, again, the solvency is more of a geographical and entity-specific requirement for each of the jurisdictions. And I'm happy to confirm that all our entities on a combined basis are much above the solvency requirements of each of the regulators in UAE, Oman, as well as KSA. That being said, the buffer that was available and the margin that was available over and above the minimum requirement, that has obviously reduced as a result of the current results. But we are above the minimum, requirements in all the markets that we currently operate in.
Perfect. Thank you so much, Ravi. I know we rushed a bit. I would have loved to open a bit more because we are on the hour now. And again, I would maybe do a last call for really urgent questions because I also really enjoy the debate. And what I recommend, again, if you have questions, please get in touch with us Again, we are also happy to meet you at our offices or anywhere to go deeper and explain a bit more, because I know that the topics are sometimes quite technical, quite complex, but it's always great to have a chance to also explain all the good work the teams are putting in. So again, I would maybe open one last time just to see whether there's anything top urgent or a question you really said, look, this is a burning question I wanted to ask, I couldn't make it. And if not, then I would recommend that you get in touch with us and we connect after the meeting, because we are always here. And again, it doesn't need to be limited just for this 1 hour on a half-yearly basis. If no questions, again, I know there are questions, but if no questions for today, I really thank you so much for taking the time. Yes, I see one question came through. Please, Shahoor. Yes, please.
Yes, hi, sir. Am I audible?
Yes.
Thank you for the opportunity to answer the question. So I just had a couple of questions on your investment side. So we have seen that that you have a large portion of fixed income investments now with the decreasing interest rates inside. Would you be able to give us some color on your weighted average maturity or weighted average yield on your bond portfolio?
So again, it is different for each of the markets. As you know, we do have a sizable portfolio in Oman, UAE, and in KSA. Again, our endeavor has always been to, because we were expecting the interest rates to correct, and in view of the dynamic portfolio optimization that we're doing, we wanted to increase the tenor, which has indeed happened in 2024. So we have increased the average tenor of the overall fixed income securities portfolio from around 2 years, that was the case, to 2.5 to 3 years. However, that's currently a journey as well, because as you know, when you had some legacy investments that were invested for a longer period of time, so that were basically below the market value during the time when the interest rates were correcting, and therefore we have to take a balanced approach as to balance between recording a realizable loss versus the return that we were supposed to generate. So we've been very cautious in terms of how we do that optimization, but the approach has always been to increase the tenor of the fixed income portfolio.
Perfect. Thank you very much, sir. So this gives us some clarity on it from 2 years to you're taking it up to 2.5 to 3 years now. Would you be able to provide us some guidance on the yield as well? What's the yield on your current fixed income portfolio?
Yeah. So again, the overall yield of the portfolio, stands at 5.2 million based on the investment income that is recognized in the income statement, the 14.3 million. So the overall yields are in the range of 5.2%. However, as you know, some of the investments that we do, particularly in our KSA, gives us a significant zakat benefit as well. And the focus and the strategy there has been to invest in those securities, which allows us to generate a healthy absolute return, but also gives us the benefit on the zakat. And we also have a portfolio classified as fair value through other comprehensive income, which has actually yielded a positive sort of return in the other comprehensive income. So if I include the total benefit of the investment portfolio on the overall financial statements, it will be close to 6.2%. So 5.2 based on the income statement and 6.2 including the zakat benefit, as well as the unrealized gains on the fair value through OCI portfolio.
And right, sir. And now, since you've classified those as fair value through OCI, I'm assuming that until you sell or these securities mature, it won't be classified in your profit and loss account. Is that correct to assume?
So again, we have a mix of equity instruments as well as debt investments. So the debt investments that are currently classified as fair value through OCI, effectively the interest income on that is recognized in the income statement. And on disposal of those securities or on maturity of those securities, any fair value gain and loss in the other comprehensive income is recycled to the income statement. While that's the case with the debt investment, as far as the equity instruments are concerned, which are fully classified as fair value through OCI, because we wanted to avoid the P&L volatility as a result of the current market movement on those securities. So dividend income on those securities are recognized in the income statement. However, any gain or loss on the disposal will remain in equity.
Perfect, sir. And for my last question, could you give us the the breakup of investments in equity versus the fixed income?
So again, 5%, on an overall basis, around 5% of our portfolio is in equity investments, and rest of it is in fixed income securities as well as fixed deposits. And again, fixed deposits are also a pretty sizable portion of the overall portfolio that we had, because we wanted to leverage the current, deposit rates, which were very, very attractive. So again, we positioned the portfolio to leverage those fixed deposit rates. But yeah, to answer your question, around 5% of our portfolio is in equity, and remaining is in fixed income and fixed deposits.
Perfect. Thank you very much, sir. Thank you.
Thank you.
I'd like to thank our audience today for their participation in today's session. Thank you very much to our Liva representatives as well for their presentations. And thank you especially to Martin Ravi for taking the last question. I do notice that there may be a few more questions and queries, but as we have now run out of time, we're 6 minutes over the allocated time, we would like to request from the audience to please reach out to our investors relations team, and we will address any of your questions in due course. Our contact coordinates are available on livagroup.co, and I believe if you require anything, we'll be able to respond to you right away. So thank you so much for joining us in this very interactive discussion. And I'd like to thank everybody and wish you all a blessed end of the month of Ramadan and Eid Mubarak, inshallah.